Dow. Joining us now, Marathon Asset Management Chairman and CEO Bruce Richards. Marathon is a global credit manager, $24 billion in assets under management. Bruce, good to have you back on the show. You've been talking about recession for a few months now. The bond market looks like is catching up with the inversion of the 2-year, 10-year curve. Is that still where you think we're headed? And if so, are you a seller of the stock rallies that we've seen lately?
So a few things to unpack right there. Number one is the 210 curve. I look at it, I say it's a negative 70 basis points because your 1-year forward rates is a negative 70. We haven't seen that since the Volcker years. So take a look at those forward curves and then look at what happened to 3-year notes. 3-year notes earlier, a few months ago, went from 28 basis points to 270 where it is now, up nearly 250 basis points. So I ask you, when the Fed actually embarks upon 50 basis points after 50 basis points after 50 basis points of hikes, because they want to get the Fed funds rate to 3%. They want to do that in the next year. And when that happens, when they're selling down their balance sheet, remember they took the balance sheet from $4 trillion to $9 trillion in just the last couple of years. When they start to reverse that, they're going to be selling treasuries, they're going to be selling mortgage-backed securities, and the market won't be able to sustain that heavy selling. So right now, there's a big disconnect between what the bond market's starting to signal and where equity markets are priced, because equity markets are only down 6% S&P on the year, but earlier in the year, they were down 13%. So you have a lot more to go, is your answer.
Downside on the stock market. I think of you as more of a credit guy, but are you shorting stocks at these levels?
Well, we have some options on where we do, but we also think high yield is going to be under a lot of pressure. You know, high yield bond spreads are measly. I say measly because it's in the 90th percentile of spread tightness. They're a measly 325 off of treasuries. That's it. And so I think they'll be at some point when stocks are down 20%, they'll be out beyond 500 spread. And so there's going to be a very different scenario for the markets when financial conditions really tighten, is when the Fed really raises rates, when the markets start to appreciate how much they have to sell down their balance sheet and what that means for treasuries hitting the marketplace, and a flight to quality that happens as a result.